Let's see if Rick Santelli sees trouble on the way. He joins us from Chicago with bond yields down sharply. Rick, Mohamed El-Erian was just tweeting that a 100 basis point move in the 2-year is a really, really worrisome sign. That's a month to date, or over the past month. What would you say?
I would say that I would have expected some worrisome signs considering everything we've been through, how long they kept rates low, how they have used their models and trusted all the data, given that seasonalities may be a bit different than they were pre-pandemic. I'm not surprised. As a matter of fact, if you look at the 1-week charts, the week to date, I mean, we closed at 438 in the 2-year. You can't make that. It's a huge move. He's right. I just don't think it's surprising. And if you look at 419 closing 10s. Now, here's what's really interesting. I continue to say that these guys, one of the big trades everybody's talked about that is working quite well is that steepener, 2s, 10s. It's hovering under -10 right now. It's at a 2-year, the least inverted. And look at the VIX. Right now, it's flying at the highest level since March of last year. And that is a good segue for this guy. Hi, Chem.
Hey, how are you, Rick?
If I do recall, we kind of warned viewers last time we chatted last week that volatility could get really juiced, especially some of the sector rotation. Why don't you pick it up right where we left off?
Yeah, buy them when you can, not when you have to, right? The reality is there's a rotation that's been going on. Risk is in the market. Ultimately, there's a buyer and a seller. It's a zero-sum game, right? But when risk gets concentrated into a part of the market and leverage, it becomes a problem. So a very violent rotation like we've been seeing can catch certain people off guard and really drive volatility at the center of the market. And that's what we're seeing, along with poor vol supply in the back end of the curve. Now vol is starting to expand, and that becomes a self-fulfilling prophecy.
Yeah, we've talked about this reflexive kind of strain that's always present in the market. We were talking about it with regard to mortgages. So mortgage rates are moving lower now. Maybe they'll get to 6.5. Maybe they'll actually get lower than that. But what can that do? What do we think of?
Well, it's asymmetric, right? There's enough pent-up demand. We're running a demand-style economy now that when those rates come down, much like they did in December when they started pricing in the cuts, you can see a pretty quick reaction to GDP and to growth. The problem is it's a slowing economy. It's dramatically slowing. And there's a wealth effect, which is ultimately with the market coming down, reflexively slowing the market at the same time. So we'll likely get demand, which will drive inflation.
And pricing pressures, and the Fed's going to have to deal with its own medicine. But yet, we all know that housing is huge if you want to try to spark some life back in the economy. Any final thoughts?
Well, I would watch, Powell and what he has to say coming up. I think they were very vague for a reason in the last commentary. I think they really have an adjustment to make. This is a reflexive machine, and he's watching these markets closely. They say they don't manage markets, but markets are money supply, and the more the market goes down, the more problem we have with liquidity.
Absolutely, and anyone who doesn't think they have both eyes on equities today is probably wrong. Tyler, Kelly, back to you, and try to have a good weekend. Don't look at your 401k.
Indeed. Buy some bonds. No, I'm kidding. Rick, thank you.